on YouTube for the Thursday edition of the Not Your Average Investor Show, the JWB Rental of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I very affectionately call GC because he generates cash flows, because he's got genius concepts. He's a great co-host, and his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you
and
today.
I didn't mean to cut you off there. What'd you say in there? To be with you today.
It was an important syllable that you cut me off for, so I'm going to repeat myself today.
Syllable. And with us, as always, the moments that matter. Madison the Magnificent. We call her MTM. She's our community manager. Say hello, Madison. Thank you. Let me get this mic away from my face.
Hello, everybody.
It's we had a couple technical difficulties going in here. Let me just move away the screen around so I'm like looking better at things that we want to see here. What am I supposed to say? If you're joining us live on YouTube, normally we're much more organized than this, but you're in the right spot. Happy to have you here. If you're listening to us on the podcast, pumped that you're listening. If you are with us today, you're our favorites. And if you want to be one of our favorites, go to nyais.com. Join us live for one of these wonderful shows where all sorts of zany chaos ensues all the time. And we like to kick it off with a little tradition.
It's called the roll call.
It's called the roll call, y'all. All right, let's do this. Madison already welcoming everybody to the Not Your Average Investor Show. We got Drew Barnhill, the ringmaster of the Not Your Average Investor Show community, saying good afternoon. We got our leadoff hitter batting second today, John Henning, saying good afternoon. We got Stevie B in the house again, twice in 1 week with a strong emoji. I agree. It's very strong, Stevie B. Strong showing. We got Leo Baraganan.
Dun, 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 dun.
Baraganan.
Dun, 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 dun.
Leo, good to have you back. I feel like we haven't sung your name in a while, man.
Yeah.
That's pretty awesome. We got
he's been hanging out in the Facebook group. I've seen a few comments from Leo, so we're glad to have you back in the real party here.
Put that closer to your face there.
Sorry, there.
Good to have you. Good to have you in the back in the house, Leo. Let's rock. We got the fairy godmother of the Not Your Average Investor Show community, Jennifer Filson, saying hello from Monterey, California. We got Louis Hudnall with my favorite place to mispronounce, Milipitas, California. Good to have you in here. We got Raj Bantu in the house. Raj is back. He says hello, all. Good to have you, Raj. We got Tony D in the house. Anthony Ditta. Greetings from Jupiter, Florida. Tony D, I've been seeing some big waves happening in Jupiter, Florida lately. I kind of like it. We got Chris Gonzaga. Biden in the Valley. Hello, all.
Oh, all right. You got the president over there.
Oh, that's right. The president's over there. I am not on the news cycle, but he's hanging out in the illustrious Hudson Valley of New York, where Chris Gonzaga hails from. We got Joshua Wedding in the house. Hello, all. Josh Wedding from Longview, Texas.
All right.
Pumped to be here.
Welcome to the party.
Welcome to the party, Josh. You're at a particularly fun party today. We got Dean Curry, the early bird of the Not Your Average Investor Show community. We forgot about that. Columbus, Ohio is in the house with Dean Curry. Who else we got? Kenyon Meadows, Dr. Meadows, St. Simon's Island. Is that a new name?
It is a new name here, I believe, but Dr. Meadows has been a longtime client and a friend and a supporter, so it's great to see you, Dr. Meadows.
Doctor. All right. we got Erin O'Neill into the lights. Erin O'Neill. Good to have you. She says hello, everybody, from Beantown, Boston, California. We got Marilyn Cotterman from a little place called...
Is that Boston, California, you just said?
I don't know. The French are jerks, We got that's a line from Dumb and Dumber that I'm butchering there. We got Marilyn Cotterman from a magical little place in the west coast of Florida called Home of Salsa. You know what happens there?
That's the home of the manatees, Paulo.
It's the home of the manatees. It's the home of the manatees. Everybody should swim with a manatee at least once. We got Sergio Prieto. Go Gators.
Go Gators.
What's up, Sergio? Good to have you in the house. Who else we got in here? Danette Colvin is back from Baltimore, Maryland. Danette, good to have you back in the house. We got the man that everybody knows.
Noah Rendari.
Noah Rendari. He's hanging out. He's normally in California. I don't know. He's being mysterious today with where he's checking in from, but I think it's California. And that's it.
And we're here.
And we're here.
And we're ready.
And we're here. And we're ready. And it's time for my favorite moment of the week. When Madison shares good news. What do you got, Madison?
All right, everybody. Super cool news. So after every quarter, as everyone knows, quarter 3 just ended. Our property management supervisor, Val, sends out an email kind of giving everybody a highlight of how her maintenance team is done. And they rocked last quarter. They troubleshot 673 work orders over the phone. Shout out to Rochelle, our main dispatcher. She's amazing. If you've ever heard her on the phone, she's unbelievable. Those 673 work orders equated to over $61,000 in savings for you clients.
What were those numbers again?
673 work orders troubleshot. That's 19% of all work order requests put in. $61,000, 653. So $61,653.
Last quarter.
Yes.
That is like the
Saved.
hidden value of vertical integration right there.
What do you mean by that, GC?
What other property management company do you know that actually tracks the percentage of work orders that get solved over the phone, right? That's why we have the same goals. That's why ultimately you have a better return on investment and a better overall experience. And shout out to our team. And one of the cool things about vertical integration is that we on the marketing team sit right next to the maintenance team. So when Madison is talking about how much she loves Rochelle and how much she loves and is just in awe of what she does, it's because you have your entire team sitting in the same pod. What's that like, sitting next to your teammates, Madison?
I get so distracted by listening to them work. I'm always, every day I'm in awe of how they handle things over the phone. It just goes to show how meticulous JWB is in picking certain individuals for certain roles, because I would have a panic attack if I had to talk to a resident about an HVAC system. It's unbelievable. I laugh at the service team because I can hear them on the phone. Everybody's just having a good old time. It's a lot of fun.
And this is something that's hard to measure, but the amount that your team understands the big picture directly correlates to your investment, right? Madison understands the big picture here, not just because she got some great training from her manager when she jumped in, but she's also in the pit. She's surrounded by client service teammates, by maintenance teammates, right? By property management, by sales, right? So it's this constant overflow of information, and that ultimately helps her be more educated and a better resource for you as an investor. And that's the way the whole team operates. So vertical integration, baby.
Gotta love it.
Love that. GC, I would like to, Madison.
Yes.
That's good news.
It was good news.
Appreciate that.
Of course.
Awesome. My favorite segment. What I want to get into, GC, is I think you explain it as that's vertical integration. I think for those of us that have been on the show for a year and a half and we understand vertical integration, we get that piece. I think that what's missing, if somebody was to like walk into this conversation, is like, what's the other side of that equation? Like, right? Like, why is that an advantage? When you say property managers don't track how much issues they resolve over the phone, why is that?
So you're saying, why don't other property managers track that? You want me to go down that path?
Yeah.
Yeah, well, it's hard to do, and they're not incentivized to actually track that, right? So a typical property management company makes money, makes 25 to 50% of the revenue in their business that comes from tenant placement fees. 25 to 50% of their revenue comes from your resident leaving and them charging you to put a new resident in place. And so if 25 to 50% of your revenue comes from that profit center right there, you are not really incentivized to make sure that you sign long-term leases, to renew residents, right? We know what our percentages are, right? Our average duration of initial lease is 26 months, right? Our average, our renewal percentage for residents that renew is over 70%. And that equates to an average duration of resident stay of 54 months. Like your residents stay 4.5 years on average in a JWB property. Why do I know that? It's because I'm on the hook to deliver returns for you. And I know that long-term resident stays equate to a better return on investment for you. And again, when we're talking about tracking something, some of you may say, listen, I never even thought about tracking the percentage of work orders that are solved over the phone. We care about that. Like 60 grand of cash flow going to investors just on a quarter, right? That's $250,000 over the year that we're able to drive in additional cash flow because we train our team to be able to solve problems over the phone. So these are things that you're never going to see on an evaluation. And all of you out there who are saying, listen, I really like this property. I like the team over there, but you know what? Their estimated return on investment is like 0.2% lower than this other team. And you go for the 0.2% higher evaluation with the less good team out there, you're making a poor decision long-term, right? It is so easy to manipulate returns on investment on evaluations. These are the questions you should be asking your property manager, your asset manager, the person who is actually going to be controlling your asset for you, do way more due diligence on that fact than, well, at least match it with the amount of due diligence you're doing on the property evaluation.
I'm really glad I asked that question because I thought I was setting you up to say that most property managers charge an upcharge for when maintenance people come out.
Oh, yeah.
So they'd be leaving money on the table by solving it over the phone.
Yeah, no, you're right about that. You're 100% right.
Is that a significant, I mean, you buy property
Yeah.
management companies all day long. Is that a
Oh, yeah.
significant revenue source for property management?
100%. 10 to 15% is the typical upcharge for when a property manager arranges your maintenance for you. So if it's a $100 trip charge for them to send out to solve a problem that could have been solved over the phone, that property management company is actually making $10 or $15 on that. Times however many work orders, what was that, 673 work orders? That would have been a whole lot of money.
Yep.
That property management company actually would have pocketed for their own revenue. And it would have been more expense than $63,000 or whatever we saved for owners, right? So, yeah, you're right.
I mean, I would assume that $6,000 is about a month and a half of salary for an employee, for an average employee of an average property management company.
Absolutely.
Yeah. Luckily, we're not average around
We
here,
are not.
right? So that's the whole explanation of vertical integration, right? It's this idea that incentives are aligned, and everything is, so it's kind of two parts when you say vertical integration. It's everything is in-house. So Madison sits in the pit and understands the whole business model. The property management team understands the business model and how this thing is built for, ultimate success of the client, right? Of the investor.
100%.
And you are also right alongside of them, winning when they win. And then there's the vertical integration of aligning incentives, right? It's like the aligning of incentives. So there's kind of like two levels of vertical integration in incentives and also in team and capacity of handling things in-house.
There's another component to vertical integration. I would put both of those really important components into like experience, a better experience for you, working with a team that truly gets it, and then short-term success, right? Call that cash flow, right? Short-term. We're going to maximize your cash flow when you're working with a vertically integrated provider. The other one is long-term success, right? And your vertically integrated provider should be in one market. They should put everything that they can into that one market to make sure that they can have better returns on investment for their clients in that one market than the average investor will get in that market. And so that's why since 2013, because of our vertically integrated approach, JWB clients have earned 79% more home price appreciation than the average Jacksonville investor.
Yeah.
It's because we know the neighborhoods to put them in. We put them in there ourselves. We look for ways intuitive or innovative ways to build, right? Whether that is new construction. We were the innovator for building new construction, build to rent, which now the big guys are doing. Wall Street is now in on that, right? We were doing that in 2013, all right? We were on the front page of the Wall Street Journal for that. Whether that is townhomes, whether that is us trying things out like building a shipping container apartment, which we did, right? These are all R&D type of activities that we do that clients benefit from. And then the latest one that you all have seen is our investment in downtown. And this is just the latest iteration of our R&D department, of our vertical integration. And we expect to see outsized returns for our clients who invest in Jacksonville with JWB over the average investor over the next 10 to 20 years. And it's because of this vertical integrated approach. So you got to get from all three angles, right? Experience, you're going to win when you go vertical integration. Short term, like cash flow, you should win. And then long term, you win as well.
Let's go. I like it, man. Cool. That's good news. That's good news. Tayo Ladipo is saying, I'm experiencing what you're discussing right now with your property management company in Georgia can really eat up your cash flow. I learned I have to advocate for myself and my property because no one else will, right? That's the opposite of vertical integration.
Yeah. And
Yeah,
that's,
sorry to hear, Ty.
unfortunately, that's where a lot of people land. You work with a company that is not vertically integrated. And I think it's very easy for us to land on, listen, nobody's going to care for my property like myself. Like, there's a different space there, right? There's your turnkey company or your average property management company. Then there's vertical integration. And then there's this doing it yourself, right? If you can focus on vertical integration, you get the best of both worlds.
Yep.
You don't have to do it yourself. And you can have somebody that delivers better overall returns on investment.
There you go. Marilyn Cotterman from Homosassa, Florida has a question.
Love it.
Home of the Manatee.
Oh, goodness. Home of the Manatee.
It's all right. It's all right. We're a little,
Gosh,
we're a little-
Maryland, I'm sorry.
you know, I'm off because this like upwards angle is making me feel fat, but don't worry about that. All right, here we go. Marilyn Cotterman says, if by chance my rental home would have to have been rebuilt due to a total destruction from hurricane situation, etc., would JWB be the company who would be able to rebuild it, for assuming I had replacement insurance?
There's a whole lot of ifs and buts there. I feel really confident that we would make sure that you are in a good spot there. I don't know 100% if the best thing for you to be would be for JWB to rebuild your home. But the really important thing is that's why you have insurance. If that would happen, your insurance payout should cover the cost of replacement, which should more than cover the cost of the build. So there's a whole lot of ways that you're going to be taken care of in that situation. And yeah, one of the options would be for JWB to rebuild your home.
There you go. All right. Well, before we go into this property, we got some breaking news. You said you had some breaking news. I have no idea what it's going to be today.
Well, it kind of dovetails into Madison's good news and then into our kind of like discussion on vertical integration. And I kind of put this out there a couple of weeks ago and you weren't around 2 weeks ago. And I don't know if you actually saw this little nugget, but for you who is the brains of the message for the show and all this good stuff.
I am the eater of the nuggets.
You are the eater of the nuggets.
I love nuggets.
I'm going to get you a business card with that on there.
Give me some JWB nuggets.
There's this little stat that I did a whole bunch of research to make sure I've validated, verified, and it's kind of impactful. So I wanted to kind of share it with you and with the audience. Again, they kind of saw it. For those who were on the show 2 weeks ago,
go on.
Kind of saw this. Did you know that 100% of JWB clients are currently beating their expectations?
I did not know that.
100. Have you seen a trend when we do the properties of the week, when we do the client journeys, and we have every client? Have you ever seen a client that we didn't hit their expectations?
I feel like the last time you told me anything similar to this is the fact that 100% of JWB clients are positive in their returns, have gotten returns. I had no idea that 100% of clients have beaten their expectations. Was this on the call with Rich? Is that one call?
I know.
Okay. Tell me more about this, man. That's insane.
Yeah. 100%. This is over 2,800 properties that we have sold to clients. This is going back. We started tracking returns in 2011. It's actually some properties that have, clients have been investing even before that, right? So 2,800 properties, right? Call it up to maybe 15, 16, 17 years of performance. We went through the Great Recession. We went through a pandemic. We're still dealing with a whole lot of things that are going on in this world, right? The stock market right now is down 23%, right? From the high that it was at earlier this year, right? There has been a whole lot of volatility. The one thing that hasn't changed, JWB clients have beat their return expectations 100%. There's not one of you out there as a JWB client that is not beating your return expectations on any single property that you've purchased.
Wow.
I mean, is that really, really cool? Like,
I'm speechless.
I put the research into this because I knew that everybody was positive.
Yeah.
And then I actually went and I checked. And it's that's the way it is. So I got done for this. You know who I called? I called my mom. I was like, Mom, look at this. Like, this is what we set out to do a long time ago, is to create access to an asset that we thought had better returns than the stock market, and that could create consistency for folks. And so it's just a huge team win. Been sharing this with the team internally. I want everybody who is a part of this community and our clients, right? You all are the reason that we have the opportunity to do this, and our team has the opportunity to do this. And, it's something that I'm really proud of, to know that we're creating a lot of really great things in this world for folks.
It's really cool, man.
Yeah,
that's awesome. That's awesome. I think you got to print out like a macro ROI report so your mom can put it on the fridge. That's the move.
It doesn't really count unless it's on your mom's fridge. Right?
It's got to make the fridge. Give her a little JWB magnet, print it out, let her put it on the fridge.
Yeah.
All right, man. Awesome. I love that, man. Thanks for sharing that. That's really cool. Like, I heard the inflection in your voice when you said you called your mom, and I can tell it was an emotional, like, what do I do now? Call my mom. And that's really cool, man. I really like that.
Yeah.
That's awesome. All right. Well, speaking of magical moments, we're about to magically whisk ourselves away here to the property of the week, which is 2185 Kistler's Ridge Way, Jacksonville, Florida, 32221. Estimated ROI of 12.65%. on a purchase price of $275,000, monthly rent of $1,743, 4-bedroom, 2-bathroom, 1,456 square foot, construction status about to be done here, leasing status available, annual appreciation rate, what Jacksonville is famous for over here on the Not Your Average Investor Show, 4.6%, and nice little picture with a patented blue sky of Jacksonville. GC, what do you love about this property?
I thought you'd never ask, brother. I'll tell you what I love about this property. Well, number one here, let's just kind of pander to the obvious, right? I spent a lot of my time talking about how we should be investing not with our eyes, not based on pictures, and not just because the house looks beautiful. That's not enough to invest, right? We should be investing based on the key property details, right? And return on investment. But you know what? When it's brand new construction, I'm going to give a little bit here. One of the things that I do love about brand new construction is that you have lower maintenance costs and you have lower vacancy costs. So the fact that this is all good looking, there's a blue sky and it looks beautiful and it's brand new construction, that's not where I'm giving in, but I'm going to say I love it because of brand new construction, because there is lower maintenance and lower vacancy costs, which gets into the property details. So we're going to start there. One of the things that especially newer clients might not know is that when we talk about these properties of the week, or if you're as a part of our client onboarding process and we're making recommendations for you to purchase the homes that we're putting you in, or the homes that you are buying, are in the same exact neighborhoods that I own my rental properties, and that hundreds of other clients own other rental properties. In fact, we used to show this map not too long ago. Maybe we'll show it sometime soon here today or in the future here, where we would just show every single dot of a client-owned JWB rental property. And the map is it's hard to tell how many properties there are because the dots just overlap each other, right?
Mm-hmm.
And so there's over 4,800 properties that we manage. And these are all primarily in these 4 core neighborhoods. And so one of the things that I love about this property is that you're not reinventing the wheel here. You're not coming up with a new strategy. This isn't a provider who has gone way outside the box to find some inventory. We're able to produce the same exact experience and the same returns and beat our returns for 100% of clients, partly because we do the same thing over and over and over again. So one of the things I love about this property is it's in one of our 4 core neighborhoods, just like every property is, but I wanted to highlight that because that's a real key to your success. And then last but not least is that estimated return on investment. Getting over a 12% estimated return on investment in today's environment, no matter what you're investing in, is hard to do. And getting a return on investment like this, estimated at 12%, that also is an asset every single month that pays for itself and has a little bit of positive cash flow left over, is even harder to do. So let's just be thankful that we have this investment opportunity, in my opinion, where you can beat inflation, even though it's 8.3%. You can have upside and growth, and you don't have to risk the farm, right? You're not speculating here. And so that's what I love about this investment. I don't know, little, side note. I love that last one about every single one of our investments. So I just kind of threw that in there as a plug for everything we do. You
are a fan of the asset class. You are an evangelist of the category, right? Which I think is really cool. And I got to ride alongside with you. I got a question for you. 12.65% seems to be a tick higher than the last couple of ones we've been seeing. What's going on there?
That's the type of inventory we have.
Okay.
11-12% estimated returns on investment. That's what we have. Nothing crazy.
Okay. There you go. All right. Sweet. There you go. Raj Bantu has a question here in the Q&A referring to your breaking news over here. When you say 100% of the clients are beating the projections, what is the time frame?
So that is any client that has owned a property for any length of time. So if they own that property, they bought it 5 years ago, I run their internal rate of return calculations, right? So I take the time value of money into account, which is the accepted way that you would calculate their return on investment. And then I look to see, I say, well, what would their market value be right now if they sold it? And I also include all of the costs that would come along with selling. And I use that to evaluate what is their total return on investment, including all 5 profit centers. And every client that owns a property. Now, there is one limitation, and I'm glad you asked this, Raj, right? I lessened out all the clients that have purchased this year because that doesn't make a whole lot of sense, right? You have costs that come in play with selling properties where if you bought one today, you don't have appreciation tomorrow, but you still do have those selling costs. So the limiter here would be you had to own for longer than 1 year. And I'm glad you gave me the opportunity to point that out.
Got it. Okay. That makes sense. So anybody that's had it for more than 1 year, beating expectations.
Absolutely.
100%. Got it. So asterisks, that.
There you go.
Love it. Love it. You were just on a call with the Fortune Builders a little while ago, right? You said you were talking about like profit centers in this economy and stuff like that.
Yeah.
Give me a little deets.
So we're doing, we're going to be at Fortune Builders Ignite. So, and I know we have some Fortune Builders Mastery folks out there. And so I hope you all are going to Fortune Builders Ignite. So a little plug there. It's coming up in November, beginning of November.
November 11th, I believe
Yeah.
it is.
If you want to check it out, all of you, if you're not a part of the Fortune Builders Network, you should be, right? Go to Fortune Builders Ignite, go Google it, find out about it. So we got asked to present there. So we'll be presenting there. And yeah, so we did a little bit of kind of an overview of the asset class and the 5 profit centers. But I think the title of what we were talking about, it was, what are the 5 profit centers and which one is the most important? And so I think that was the big takeaway from what we were just talking about on the podcast, is really helping people see which is the most important. So I would love, let's involve the audience here. Maybe we'll talk about something else in the meantime.
Okay.
Right.
Yeah.
But I would love to point that out to the audience. There's 5 profit centers, right? There's net rental income.
They're already beating you to it.
Yeah. There's tax savings, there's principal pay down, there's home price appreciation, and there's inflation hedging. Which do you think the most important profit center is?
All right. Let us know in the chat. I know Drew Barnhill, the ringmaster, is already going in there with something hot and heavy. I got a question going back to this 100% expectations. Does that mean that everybody that has had a home for more than a year, if they go to their client ROI report, it would show that it's beating expectations? Or does that happen when you do your analysis of like home price appreciation?
I'm really glad you asked that, because on the client ROI report, that shows short term. That shows profit centers not including home price appreciation and not including inflation hedging. So the client ROI report, which is our monthly report that we send out to all of you clients out there, what you see is your expected return and you see your actual return, but that does not include home price appreciation. So it is not the total overall return. We can prepare your overall total return on investment upon request. And so if anybody has any question, would like to see what your total return on investment is, you can reach out to your portfolio manager, or you can just jump on the show, right? We leave space for our clients to be on the show, just like Richie was on the show a couple of weeks ago. So if you'd like to have a breakdown to see exactly what your returns on investment are, including your home price appreciation, jump on the show with us, join the party, or reach out to your portfolio manager.
So when you went out and calculated this whole thing, did you go individually or did you use kind of like an overall thing?
So what I did is I looked at those clients that had the worst returns.
Okay.
Because if they have the worst returns, that would be the greatest likelihood that they would have been underperforming. I went to those clients first, and then I went down the list and I went through, 20 clients. And I ran through and I did property evaluations and return calculations for each of those 20 clients. Some of those clients own 5, 10, 20 properties. So it was a whole lot of evaluating properties for me. And, but I thought this was important to share. And so I went down the line, I put the manual calculations in to make sure that I could sing it from the rooftops. And that's what I've been doing lately.
There you go. All right. Sounds like a party at the Cohen house. Huh? Is this guy cool or what?
Friday nights, man. There's even better tax savings conversations. I don't know.
I figured that much. I'm going to start bringing that up on our runs whenever I want to get really beat down into the ground by you. We've had a bunch of answers in the chat. We've got 1, 2, 3, 4, 5, 6, 7, 8 answers. 6 of them have been appreciation. 2 of them have been inflation hedging.
Gosh, we have such a savvy, educated group, don't we?
We do.
We do. So 6 of you for a home price appreciation. I'm going to say yes, but. Okay. I'm going to say yes, but. So there is a component to rental property investing. The first component that attracted me to this asset class was not high upside, because there's a whole lot of asset classes out there that have high upside. The thing that attracted me to this asset class and made me quit my job and invest in, 300 rental properties and build a company like this was not high upside. It was the combination of risk mitigation and high upside. So the first profit center to pay attention to is cash flow. we need to make sure we're investing in assets and not liabilities. That means that each property you purchase needs to be break even or maybe a little bit above when it comes to the amount of net rental income that you receive every single month. Right? That's the definition of an asset and liability.
Yep.
Once you overcome that hurdle, then the most important is home price appreciation. And the reason that we see that home price appreciation is the most important, it's just math. Okay, it's just math. I get to manage over 2,800 rental properties that have been purchased through us. There's 4,800 that we manage overall. 2,800 of them have been managed by us. I actually see what their total returns on investment are. You know, I do the manual calculations if I need to. Right?
I know you do. I know you do.
Well, every time I do the manual calculation and then I turn it into a pie chart and I see what is the total return broken down by profit center. And every single client who has owned the property for a substantial period of time, longer than 1 year, every single client, the same pie chart starts to evolve. And the biggest piece of the pie is home price appreciation. 60% to 80% of the total pie of your total return on investment comes in the form of home price appreciation once you hold on to the property. So if 60 to 80% of the pie is a certain profit center, would you call that the most important?
Yeah, I would say so.
Yeah.
The most significant.
But the crazy thing about rental properties, man, is that home price appreciation is the first one that people say, I'm not paying attention to. It's 60 to 80% of your overall return on investment over a full market cycle. And investors out there say, listen, I'm not going to count on the fact that it's going to appreciate. But at the same time, they have their money in the stock market and it might be down 23%. And I'll say, why are you keeping your money there? And they're like, oh, well, I know the stock market's going to come back.
Yeah. Yeah.
If you look at real estate, over time, real estate comes back every single time. It comes back to the average every 10 to 20 years. Why do we give the benefit of the doubt to the stock market that it's going to come back? Why do we keep our money in there, even though it's down 23%? But when it comes to real estate, we're like, listen, I'm not going to count on appreciation. I don't know if that's ever going to happen.
Yeah.
It's just a double standard.
Got it. So in classic Gregg fashion, we asked what the most important profit center was, and we got a soliloquy of sorts, I guess you could call that in Shakespearean times. But it comes down to the most significant one, the one that's going to impact your retirement, your wealth creation is going to be home price appreciation. Just so happens that in order to really count on that, you want to be there for a long time. And if you're going to be there for a long time, then being cash flow positive is an entry point, right? Like you got to make sure that that's happening too.
The entrance to the dance.
Entrance to the dance.
After that, focus on markets that have shown that they appreciate more than others. And that will equate to hundreds of thousands of dollars of additional growth just on one property for you over a full market cycle. Imagine if you had 10. It's truly $1 million decision.
Wow. Yeah. You know, I was actually just, I was listening to this podcast, Money with Katie or something like that. It's like a big podcast that's growing in like wealth, right? And she was talking about like how to get $1 million worth of wealth in like 10 years. And I was kind of doing the math and I'm just like, you know, I thought that when I think about $1 million in wealth in 10 years and I think about the stock market, and I'm not like super financial calculator numbers crunchers guy, but I kind of started looking at my portfolio and I'm like, am I going to be there in 10 years? You know, like if I bought a house that is 120,000, another house that's like 140,000, and another house that's like 225,000, and these things are appreciating at the rate that they've been appreciating for the past couple of years. Maybe it's not 10 years, but I feel like that's going to get to $1 million in equity and like debt pay down and appreciation and all that stuff pretty quickly, right? Like under 20.
Yeah. Yeah. I love that you're making the connection between like how quickly could I get to $1 million in my overall portfolio, whether that's stocks, bonds, or real estate, and the return on investment here. So when we talk about 12.65% estimated return on investment, that's your money through all of those profit centers. All of that combined gets to that 12.65% return.
Yeah.
Which in the stock market over a 10-year cycle or a 20-year cycle, you're expected to earn about a 10% return. It's even less than that if you
Less
think
than
about
10%, right?
Yeah, well, it's less than that if you calculate the time value of money. We did the numbers on it. It was actually 9.7% when we compared it next to Warren Buffett's
Next to
return.
Berkshire. Yeah, right.
Berkshire's return. So call it 9 to 10% of real return in the stock market. In real estate, every year, right, your average returns would be 12.65%. This is an opportunity for you to earn 30% more in rental properties than you would earn in the stock market with consistency. The fact that values and rents are not going down, right? They didn't go down in the pandemic. But oh, by the way, what's happening in the stock market right now is really hurting people. People are down 20%, 25%, some people a lot more than that, right? This amazing combination of 20 to 30% more upside with consistency that's why I went all in.
Yeah. I mean, that's why I've gone all in, because you've convinced me of this thing.
Yeah.
Right. Cool. We got a group of questions here from Jim Kirko. Jim says, sorry, but I have many questions. Jim, do not apologize, right? Like we love questions. So let's go one by one here. He asks, would you mind answering the following? That's question number one.
Yes.
You would mind?
Oh, wait, sorry.
I did not see that coming.
I'm sorry. No, I was already thinking about other questions. I do not mind.
All right. Question number two. Which product gives you higher returns across your own personal portfolio, new or aged homes?
We don't see a difference. We don't see a difference. And if you think about it, homes that you're owning for a long period of time, the newness wears off after like a few years, right? And if you go back and you look at the home price appreciation rates of homes that were built 20 years ago versus homes that were built 30 years ago, there's no difference, right? It's based on other things. It's not based on the age of the home. So over our entire portfolio, over 300 homes that we own, and then over the portfolio, over 2,800 homes that we maintain the reporting for, we don't see a difference based on new construction or renovations. And that's why you don't see a difference for the annual appreciation rate in our valuations.
There you go. That's question number two. Question number three. Do you see requests from tenants to rent a new versus an older property, more or less?
Well, so yes, people like to rent new homes more than they like to rent old homes. But you know what the great equalizer is? The rent that you charge. So people are willing to pay more for new construction homes, and the rent that we charge is higher for new construction homes. People would prefer to live in a new construction home, but if they don't want to pay that rent, they're super happy to live in an older home because that's the vast majority of homes in these neighborhoods. It's not like it's a bad thing, but the rent is a little bit lower for a renovated home than a new construction home.
Got it. So when you're talking about an equalizer, so this is, if we're talking about supply and demand, right? Like there would be, all things equal, there would be higher demand for a new construction home than a existing home, right?
Yes.
That being said, because the price is a little bit higher for the new construction home and the price is lower for the renovated home, then that demand evens out based on supply of people that can afford that rent versus the other rent.
Yep. Look at this home, right? This has a purchase price of $275,000. Have you seen a renovation at $275,000 lately?
No, I haven't.
No. So new construction homes cost more, but then look at the rent here, $1,743.
Yeah.
You haven't seen many renovations that have $1,743 in rent coming in. So higher price, higher rent for new construction, lower price, lower rent for renovations. And at the end of the day, it all works out to about 11 to 12% estimated returns on investment for both of them.
And if I'm thinking about it as an investor, right, what I really care about is minimizing turnovers, right? Like minimizing time that it's not producing cash flow. So Jim's question is really asking, is there a lower vacancy rent rate in a renovated home versus a new construction home?
They are very comparable, right? They're very comparable. So not a noticeable difference between new construction and renovations in terms of vacancy cost. Maintenance costs, you'll see slightly higher maintenance costs for renovated properties versus new construction, right? On a new construction property, we would estimate a 4% loss to maintenance cost each year. On a renovated property, it's 7.5% that is lost due to maintenance cost on average every single year, which just makes sense. Like renovated homes were not just built. So they're not new construction and things break less for a new construction home, but it is not substantially different. And the cool thing is that you win different ways in new construction and renovation. So for a new construction property, it's going to be a little bit more expensive, right? Your property taxes are going to be a little bit higher than a renovation. Your maintenance costs are going to be a little bit lower, which is nice. But at the end of the day, you get back to 11 to 12%. Renovations, you're going to win because your purchase price is lower, right? Your property taxes are lower. Your maintenance costs are a little bit higher. And so you get back to that 11 to 12% overall. And the growth trajectory of both of them, the appreciation rate for both of them is the same. So that's why we wind up at the same spot where I'm agnostic between brand new construction and renovations. I have both of them in my portfolio.
Got it. All right. Good questions, Jim, so far. We got a couple more. Are you having problems finding existing homes to buy? And do you see home prices decreasing in Jacksonville?
Yes, we are having problems finding existing homes to buy. That has been the state of things for years now. There's just not enough existing inventory to feed the demand that we have for our investors and that the housing market has. That's what we talk about. That's why we talk about housing undersupply being a big driver of why home prices have appreciated so much. So yes, that continues to be an issue. And the way we solve that is through new construction. So we're prepared. We have enough inventory for clients. You want to purchase this home on Kistler's Ridge Way, actually just walking into the studio here for the show, I found out that this home was actually just purchased.
All right. Yeah.
But I do know that we have other homes that are almost exactly like this one. And whether that's new construction or renovations, the numbers are very, very similar. So if this is something you're interested in, reach out to the team, reach out to your portfolio manager if you're a current client. If not, you can go to chatwithjwb.com and set up a time to meet with our team, or you can just reach out to Madison right now and let her know you're interested, and we'll get you set up for a phone call. And then, do you see home prices decreasing in Jacksonville? So here's the thing: home prices always decrease when it goes into fall and wintertime. From July to December, on an average year, you lose 12% of value every year on average. It's called seasonality. So this is a nuanced answer for you. Do I see home prices decreasing from month to month? Yeah, but guess what? That happens every year. The only year it didn't happen was the last 2 years when you had the pandemic and you just saw prices raging. So home prices should decrease at a very marginal level as you go into month to month through the rest of the year. And so, no, I don't see home values dropping faster than they should, but this is very normal. We've talked about this for months now of what you should expect. Home values from a month to month perspective should go down as people are not out there looking for homes as much. There's not as much demand. And then guess what? Next year, you're going to see prices go up, especially when it gets into spring and summertime. So there's that seasonality component of it.
But that seasonality that you talk about, that's for retail, right? Like that's for somebody that's going to move into it. These like investor purchased homes, does it also dip?
A very good point. I'm so glad you asked me that. Yes, I'm talking more macro now when I'm talking about seasonality.
Mm-hmm.
I'm primarily talking about primary home purchases.
Mm-hmm.
And so that's very different than your turnkey property. So JWB's inventory does not go down in price. We don't take price declines. And if you think about it, at the end of the day, why would we? Right? We have a lot of demand, but even beyond that, our properties are rented out and they pay for themselves. So if I know that there's a seasonality component to this, there's no incentive for me to drop the price on this when I know that, home values would just go up due to seasonality 3 months, 6 months later. So that's not how your turnkey providers, your reputable turnkey providers you're not going to see price decreases towards the end of a year because they just don't have that incentive to do that.
Got it. Okay. There you go. And last question. This one's a doozy.
Okay.
Jim asks, is JWB more profitable in the acquisition, disposition, and construction arms of the company or the property management arm?
That's a really, really good question.
I'm surprised nobody's ever asked that.
We have never been asked that question. I love that question here. So when we first started our property management company, it was 100% based on we'll call it the sales company, right? Well, the home buying and construction and then selling of the properties. That was our major income generator. Now we manage 4,800 homes. And so when we look at the numbers, it's not always that story. And this is a beautiful thing for you as an investor, because if you are buying your properties with a company that makes all of their money from the sales of the property, it's a little bit of what would happen if those sales dried up equation,
Company
right?
would go away.
company would go away. They wouldn't be able to fulfill the services. If they're your property manager, you might have to go and find a different property manager. It's not vertically integrated. You might have a whole different set of expectations, right? So there's a little bit of risk, right? When you're investing with a brand new company, or when the majority and overall amount of their income comes from home sales, right? We started on this venture many years ago, right? About 5 years ago now, we opened up our property management services to not just serve the clients that purchased homes for us. And that was a very big decision because, the clients that buy the homes from us, the management, it's just like a perfect unison, right? We get it. We get each other. When we made the decision to open up property management to clients that didn't purchase the home for us, there's a whole lot of differences that we bring into the equation, variables.
Yeah.
What was the quality of the construction of the home before us? What's the investor mindset? What neighborhoods do we want to serve if it's not our 4 neighborhoods? How do we retrain our team of 100 individuals to make sure that we can deliver this well? So there's a whole lot of variables there. We decided to lean into that because we envisioned a time where our income was not totally dependent on home sales. And that a significant part of our income would be driven by our property management revenue. And so we are there, right? I don't know what the percentage is, but some months one of the companies earns more money and some months the other company earns more money. Property management is slow and steady and increasing. Home sales, sometimes it's like this, sometimes it's like this, sometimes it's like this, sometimes it's like this, right?
Yeah.
And we've been doing this for 17 years and it's still like that in the home sales company. So think about if you're a brand new provider and you're just like, hey, I just found this thing I can start to sell, turnkey properties. Imagine what their income is. It's like this, this, and that's all they have. So this is why, we're going to be here in 5 years, 10 years, 20 years. And another big important factor for you when you're thinking about making an investment that should span 10 years, 20 years.
So the answer is even, Steven?
Yeah, it's really close now.
Okay.
It's really close.
Yeah.
I don't have the exact percentage, but it is really close. Some months it's property management. Some months it's the sales side of the business. And that's a win for everybody so that it is more even. And that's been a 5-year journey for us.
Interesting, man. It's really cool.
Yeah,
That's
great question.
Great question, Jim. Yeah, that was awesome, man. Technically 6 questions because I think you had 2 questions in one. So you got it, Jim. I appreciate it.
I almost shut it down right off the bat. I said, no, it wasn't interesting.
We almost punted right there, man. All right. Laura McElroy's got a question. She's asking, this is what you said, right? All of JWB calculations do not include asset appreciation, correct?
Thank you for the opportunity, Laura, for me to explain this well. So when you're thinking about buying a rental property from JWB and you look at our evaluations, you work with our team, we are going to put in the historically accurate home price appreciation expectation. So when you're buying a home from us, you're going to see that we estimate every year that on average, you'll see 4.6% appreciation. Now, in your client reporting, which we report on every single month, that does not include your home price appreciation factor in there. And the reason is right now is because it's still a super manual process, right? We're working on ways to be able to automate that, but the solutions that we have found up to this point do not give enough accuracy for your actual home values to trust it to where I want to put it in front of all of you. And so we're working internally on finding something that we think, number one, can be accurate enough for us to evaluate it. So the reporting that you see on a monthly basis does not include your home price appreciation after you're a client that you've already earned, right? And so as a client, if you're seeing your client ROI report, and let's just say that it's negative, like let's say that you were expecting 10% and you earned 8%. So it's not negative, but it's below expectations.
Below expectations.
Yeah. Let's say that you were expecting to earn 10% and you're earning 8%. There's a whole nother amount of profit center that's just not reflected there. Mm-hmm. And if you'd really like to see your overall total returns on investment, we're happy to do it upon request, or you can just join the show and I'll do it for you.
That's right. That's right. We are looking for guests for these Thursday calls, right? Like we're doing it once a month these days. So we love having guest investors. So if you want a Superman, you will looking at doing it for you, then join in and GC will do it for yourself personally. Sergio Prieto, Go Gators, has he put here in the chat, what is your current average days of vacancy while going through a property turn? I just went through a turn and JWB was able to get the property rented out again with a 3-year lease in 11 days, and he's very happy. Madison responded, our turn team shared with us that 70% of turns have been getting done in an average of 10 days.
That is awesome. That is awesome. So that's a great stat for us to talk about, because there's a couple different components when your home is vacant, right? There's the amount of days that it takes for us to take possession of your property, to assess and do a scope of work, to get your approval on the work, and then to do the work. And so to do all of those things in 10 days or less is really quick, right?
Yeah.
Really quick.
Yeah.
And that's our goal. That's vertical integration. That's why our team, our construction turn team, just did a presentation on Tuesday, and they shared, hey guys, listen to what we're doing to affect our clients' return on investment. Like, what other property management company has talent like that on the construction turn team to get up, stand up in front of 100 people and say, listen, when I make this decision to save a day here, it saves a client's return on investment that much, right? That's the depth of vertical integration that you want to have. But to get back to her question, man, I am just like doing a whole bunch of soliloquies today, and I'm loving it. I hope you guys are enjoying it, but I love talking this stuff. So there's the time that it takes to get the home back on the market, which, like we just talked about, 70% of our renovations have had less than 10 days. Well, then there's also the time to market the home. And then there's also the time for your resident to move in. So that market to move in historically for us is about 40 days. So if you want to call it 10 days on average-ish or something along those lines, plus 40 days, that's what actually affects your bank account, right? Because once that resident moves in, that's when rent is collected for you and deposit is collected and all that good stuff. You know, if you're asking numbers from other turnkey providers, you might want to say, hey, listen, include your turn days. Include the days that it took to market the home and get a deposit on it, and include the number of days that it takes for that resident to move in. Most people only count the number of days when it hits the market until it has a deposit on it. So that's how you compare apples to apples.
There you go. Awesome, man. Great little soliloquy there. Juan Camilo Saldarriaga has a question. If maintenance of used property, aka renovated property, is 7% and appreciation is 4.5%, then I get 3% negative that I would need to compensate with rental income. Can you help me understand if this is correct?
I super appreciate that question, Juan. I absolutely can help you here. So when we're talking percentages, we need to understand, what is that a percentage of? Because percentages can be kind of confusing, right? 4%, 7.5%. But understanding what it's percentage of can have a dramatic effect on your conclusion here. So when we're talking about maintenance costs being 7.5% for a renovated property, that's 7.5% of the rental income that's collected. Okay, so I don't have my phone on me here, but if we want to do the math here, right? Let's have the audience. If somebody, let's say that rents are $1,000 a month.
Okay.
Just to keep it simple.
Okay.
We got to annualize that. So let's say $12,000.
Okay.
If somebody would be so kind as to do $12,000 times 7.5% times 0.075 and tell me what that number is, I'll move on to the next point.
It'd be like 8,400, right?
Gosh, you're so good.
Yeah.
All right, let's double check Pablo there. We're going to take 8,400. No, it's not 8,400. It might be
840.
Yeah. All right. 840, 900.
It was $900. I was way off.
There we go. All right, cool. So that's the cost of maintenance that you should expect each and every year on average. All right. So $900 cost. Now, when we're talking about home price appreciation, that's a percentage of a different thing. So that's a percentage of the purchase price of the home. So now, my friends out there, Raj, Misty, Andrew, everybody, thank you. Let's do $275,000 times 4.6%. Do you know what that is?
I'm gonna have a hard time.
You are the genius of the bunch here.
Oh man, $275,000 times 4.6, like 20. It'd be about like I would guess somewhere around like 17 grand.
Okay, well, you were close.
No,
No, you were away. So 12,650, if my eyes don't deceive me.
There you go.
So $12,650 is what you're earning in equity buildup, in property appreciation. So that 4.6 actually equals 12,650. So you're earning a lot more in home price appreciation than you're giving back in maintenance costs, and it's just based on what you're taking the percentage of.
All right. And this is why you don't do math in public, just for the record, Juan.
That's why I was asking for help.
Yeah. I'm glad that Misty and Drew and who else and Raj were here to help me. Thank you for bailing me out, as the community always does when I need it. So there you go, Juan. It's that's the math. I hope that was excellent. All right, cool. He got a good answer, Juan. I liked pronouncing your last name, just for the record. All right, Chris Gonzaga. We got 2 more questions. Let's rapid fire here. No more soliloquies.
Okay.
Any demand these days for 5-bedroom homes and the new homes going forward? What's the most popular build bedroom wise that JWB will be building?
Yes, there's always demand for 5-bedroom homes. We don't have a problem renting 5-bedroom homes out. So yeah, we definitely have demand for those. We don't build new construction homes that are 5 bedrooms though. Just because the cost to build 5 bedrooms doesn't make sense to do that. So as far as new build plans, we're not trying to reinvent the wheel for build plans, right? It's either 3 bedrooms or 4 bedrooms and 2 baths. And usually the main reason we decide either 3 bedrooms or 4 bedrooms is how big the lot is. And if there's certain setbacks and things that we have to work on, we would like to build as big of a home as possible, but sometimes we can't. So that's why sometimes you have 3-bedroom homes and sometimes we have 4-bedroom homes. And then we also take the neighborhood into account. You don't want to build the same thing over and over and over again in a neighborhood. So we adjust that.
Got it. I appreciate you keeping that short.
You're welcome.
Ken Moline, patriarch of the first family of the Not Your Average Investor Show, probably with Carolyn, who's the matriarch of the first family. We salute you. We didn't get a chance to say hi in the roll call. He says, does renovation include upgrades to current hurricane response codes?
Yeah, absolutely. Renovation costs include any upgrades that would be required in order to maintain insurance. We've seen more of that for our clients like Ken and Carolyn, who have owned properties with us for many years. Insurance requirements are, sometimes they make us fix things and all that good stuff. So yeah, that would include that.
All right. Final question from Jim Kirko. It's Oktoberfest, so I need to know your favorite beer, because next time you're in San Diego, I'm buying. Thank you for all the information you provide. It's rare to get honest information. Favorite beer, GC?
Oh, that's awesome. Man, this year I love Leinenkugel Summer Shandy.
Oh,
yeah.
Look at you.
I know. That's been my favorite, and I'm a little sad because it's no longer summer, and that's not going to be found anywhere on the shelves. But yeah, that's my favorite beer right now.
There you go. I would say I'm a Red Racer IPA from Beer Republic. I'm a fan of that. So
that's a much cooler response, by the way.
Well, you're the brains. I'm the cool. This was awesome, man. Started the show a little bit in chaos, right? Had a hardware problem. My brain wasn't totally working, but the community showed up and helped out, man. This was really, really great. Appreciate you all being here. I don't even know how many people we've had on. Oh, we got 47 people on right now. So I assume we must have been breaking 50 throughout the day. We just never take it for granted that 50 people take an hour out of your Thursday, middle of the workday, to hang out with us. So really, really appreciative of you for being here, making the show what it is, asking great questions like Juan and Jim have, which, by the way, are the same name in Spanish and English. No, John is Juan. Sorry, man.
I was going to say.
Oh, God, I was way off. Anyways, making sure what it is. If you've been hanging out with us in the car or listening on a podcast or watching on YouTube, go to nyais.com. Just join us one of these days. Make a little time for us. Put it on your calendar. It's a non-intrusive reminder, and we hope to have you here so you can be part of this community. Tuesday, we're kicking off another Not Your Average market set, Not Your Average Insights, which is our favorite content pillar, leading off with this question. Did you know that a bear market is worse than a housing crash? Tune in Tuesday. You're going to find out. It's going to be great. GC, last words.
Just love what you guys allow Pablo and I to do. Thank you for being here. If y'all didn't show up, we wouldn't be able to do this show. So you guys coming each and every week, making it a part of your routine on Tuesdays and Thursdays brings us so much joy. And you're the reason that we truly enjoy this. So thank you so much. Can't wait to see you all on Tuesday and do another deep dive. I think it's gonna be a good one.
Love it, man. Remember, we'll see you Tuesday. And until then, just do us all a favor. Don't be average.